All right, welcome everyone. Thanks for joining us for our March webinar. This one's going to be an exciting one. It's all focused on whole life. Before we get started though, I wanted to make a couple of new announcements about the system. The biggest one being that we've finally got our French translation done. And it is live on the site. So if you are from Quebec or a bilingual user, again, simply click the FR icon at the top and you're going to notice that everything on the site is actually translated in French. And again, within the actually account settings when you're logged in, you're going to be able to see that so you can change the report over as well. Again, if you're joining us for the first time and new, you're not yet quite using Life Design Analysis, if you're remotely interested in it, again, make sure you create an account. Again, we have a free sign up. First 30 days are free, and then we have packages ranging from $30 to $65 a month. But again, because there's no credit card up front, there's no risk to try it out. And again, I think once you try it, you're going to find out how valuable it is. Again, today's webinar is a little bit more advanced because we are diving into some different whole life concepts. However, generally the system overview is fairly simple and straightforward to go through. So I mean, if you are joining us for the first time and this is your first taste of it, we're definitely going to show you a few things like how to import a whole life quote and some different things that definitely can be compared in the system. But this one is more intended as a deep dive into whole life and how we can position it for our clients, some different aspects of it, and things we might want to consider when we're actually selling a policy. A lot of us fall into these kind of routines, I think, with product types, and maybe don't even necessarily realize that these options are out there. So today we're going to be looking at a lot about comparing whole life to whole life. We're going to do some things like comparing different dividend options. So by far and away, paid up additions are the most popular. And for the most part, I'd say they're the most valuable, but not everyone can afford a paid up addition. So we're going to explore some different dividend options, how we can compare them in life design analysis, and when they might be used. And after that, we're also going to be comparing different funding mechanisms. And what I mean by that is we're going to be comparing things like when to use ADO and the impact on it. So when I set up these compares, the one that I'm going to use there is basically, I'm going to use two par cases, but instead of increasing, the premium, one, I'm going to do it with ADO. In the other example, I'm going to do it by increasing the face value, which is going to, again, increase that cost of the policy and also the cash values. And what we're really going to be looking at is the impact on an IRR basis, because, again, it's going to strip away all those kind of differences and really focus on what has the best bang for basically your client's dollar. And again, we're going to be looking at it in terms of cash IRR and insurance benefit IRR. And I think we're going to find some really interesting conclusions from it. And then we're going to end off with a guaranteed 20 pay versus pay to 100. Now this kind of came to my attention actually quite a long time ago when I first started actually working for my stepfather in the industry. I did kind of a little bit of a research project onto the impact and the IRR of different dividends. But looking at agents, and a lot of times people come to me and say, I'd like you to review this case, and just again, because I see a lot of things and do a lot of testing on these policies, I get questions like when to use that 20 pay, the guarantee, versus say a pay to 100 that's been offset. So we're going to do a little bit of exploration around those topics as well. And again, we're going to do some head-to-head comparisons. Today's webinar, again, I'm going to use mostly the Sun Life product, and not just out of favoritism. I just want to keep it simple and use one company. So, a lot of these concepts most definitely, when we're doing a whole life to whole life, could certainly be used across carrier. Today's webinar, though, is going to be mostly focused on the Sun Life product, though all these concepts will apply with any carrier. So, every carrier that I know with a decent par plan out there has a guaranteed 20 pay, and has a life pay options. Most have a eco dividend, and that's one of the ones we're going to look at when we look at the dividend option. And again, we're going to compare that kind of to a term rider. So let's get started. Again, this is the main dashboard, and again, I'm going to assume most people are familiar with it. We're going to start out with the most simplistic one, though. I'm going to start and create a new case, and again, I just use my sample case on these kind of ones because I find it's a very nice baseline. This is a 50-year-old male. He's a non-smoker, and you can see I've done a needs analysis for these. Now, again, you can choose to add that in the report or not. So the first question I often get asked is, how do I bring in a whole life quote? So, for the most part, our system, again, because of that Life Guide association, we get the term rates and the universal life rates fed directly to us. We do get whole life pricing, but generally when we add a whole life product, as you'll see I'll do right now, I'll say let's add one. And again, like I said, I'm going to add the Sun Life whole life product. we get to this screen right here where we see, we have two options really. We can either import from CSV file or we can paste the information in there. And again, this really depends on what you're most comfortable with or what the illustration software provides. So the reason I've picked Sun Life today is that the actual illustration software, the EOS software as it were, let me just flip over to it, actually when you say view spreadsheet and you actually go to export the spreadsheet to Excel, this little button up here, it actually already comes in a CSV file. So it really could not get easier when you're doing a Sun Life product. So just to give my first kind of example here, I'm going to make a PAR protector and I'm going to choose the 20 pay option. So instead of this premium option here, oftentimes there's a life pay or pay to 100. Generally, whole life PAR companies offer this 20 pay option. So this is the first one I'm going to start with. Again, I'm using the PAR protector and it's going to be a 20 pay. I'm going to do everything annually. Again, I always recommend doing apples to apples, so I'm just going to keep it simple and do it yearly. So basically what you're going to do is you're going to design your quote, and I always say this includes anything like different term riders, any different dividend option, which again, like we're going to get into that later, and any premium offset. In this case, I'm just choosing the straight up 20 pay. So like I said, it's very simple to get into LDA. All we're going to do is say, let's view the spreadsheet, and again, export it to basically either Excel or in our case, we're actually getting a CSV. And I'm just going to do it to my desktop and call it Sun. And I'll save that. And basically this is my 20 pay PAR protector in our case here. So just to kind of reaffirm that. So once I've saved the spreadsheet, again, it's saved everything from this quote. So really all I have to do is go back into my life design analysis. And again, I can import my quote just by, in this case, I'm going to say import a CSV. And again, you can drag it in there or click here and get it from the file browser. And as you can recall, I saved it as that Sun CSV, so that's the one I'm going to open. Again, once you click open, if it's a CSV, it's automatically going to upload. Now, because in today's example, we're going to get into a few different options, there's a couple key things I want to point out. I want to point out that you can also edit this plan. This is where you can change the details. And again, in something where we're getting a little more complex, I want to be really clear what we're actually doing. So I'm going to say this is a Sun Life PAR protector, and I'm going to say it's a guaranteed 20 pay. So I mean, it doesn't matter what happens with the dividend, they guarantee that this is a 20 pay. So I'm going to say guaranteed 20 pay whole life participating plan. Again, add any different description or notes that you think is going to, kind of either give more detail to your client or have them ask questions. I mean, these can be breadcrumbs too, where you put a little, like, what does participating insurance mean? Well, great, that's a fantastic question, and I put it in there so that they'll raise that question. So that's as simple as it is. Basically, I've got my PAR protector in there. It's going to be named all over. And again, if I want to see it, all I have to do is generate my report. And I'm going to see, here's the premium. Here's the pay schedule. Again, we can see it 20 years at offsets. Here's the sum of premiums. And again, we're just looking at the one plan right now. This is a showcase. And again, it's produced all these charts. And if I want to, I can always go back and make sure that the data is accurate, 39,800. I mean, you don't really have to. We are meticulous around here. So there we go, 39,800. So that's perfect. So that's how we get our one whole life quote in there. Now, let's assume we want to compare this whole life. We don't just want to look at it. We want to say to our client, you have two options. You can either go for an early cash value plan, and generally those are called wealth maximizing plans where the early cash values are stacked up, or you can go with an estate plan. Now, in Sun Life's case, their PAR protector is their estate plan, so it would give those later cash values. But again, I know that everyone listening today probably knows that, but it's all about showing your clients. So they may not know what's more appealing, early or late cash value, and they may not know the balance. So this is a great way to use our overlays on multiple whole life plans. And this is one of the great features of the Elite plan, is that we can add multiple whole lives. So what I'm going to do is I'm going to add another Sun Life whole life plan here. And again, it's going to ask me for the same sort of information. I need a CSV file. Well, this one, what I'm going to do is I'll edit the title up first. So again, in this one, I'm looking now at Sun Life PAR, and I'm going to pick the accumulator. And I'm also going to pick a guaranteed 20 pay. So I'm going to say guaranteed 20 pay. And again, some of these forms you can pre-populate as you fill out. You're going to notice some patterns as you do them again and again. So again, I'll put that in there. Now, the only thing missing is the spreadsheet. Now, I've actually gone ahead in this webinar and saved a couple different spreadsheets just to save some time. So I'm going to say import from CSV file. And I've actually saved in my Dropbox here some spreadsheets for this webinar. And again, I've named them appropriately. So in this one, I'm actually looking for the par accumulator, PA, and I'm looking for that par accumulator 20 pay. So there it is, the Sun Life par accumulator, guaranteed 20 pay. So that's the one that matches my other quote, and that's going to keep it a nice apples to apples. So this is great. I've got both my data in these plans. Again, I can tell because it's one, it's told me it was successful, and two, those blue buttons telling me and instructing me that I need to add data are gone, so I know that it's in there. I am going to push this out and say let's look at it to age 99. Again, you can adjust this to whatever. And again, because my client's 50, I don't really want to look at the IRR until about 30 years in. In fact, I'm actually going to go down into my table here and say we're not really focused on the needs analysis for personal or business. And instead of, I don't want alternate, I'm just going to kind of streamline these reports a little bit for this case. Instead of using an image for the charts, I'm actually going to use a table too, because I actually want to see that deposit difference or the IRR difference. Again, like I said, a lot of what we're doing today is going to depend on kind of the internal rate of return. Because as you'll notice that if we look at these premiums, $39,800 for the protector, and 43 for the accumulator, we are putting in different deposits. And a lot of people say, you should match deposit to deposit if we want to compare them. Well, IRR is going to help us tell that rate of return regardless of the deposit. And again, we may, a little later on when I start getting into it, I am going to do them match dollar for dollar to show some differences of plans. Now, the other one that I want to make sure that you have on is this total cash value overlay. So here, chart cash value overlay and chart insurance benefit overlay. And I always recommend turning those on in your account settings as the default, because if you don't have two plans with cash, they're not going to show up anyway. So you might as well have them on. It saves you trying to think about it. Again, it's kind of one of those smart components. And again, if you're ever wondering about one of our components, simply move your mouse over the question mark and it's going to show you. Let's dive into this case. So let's say our client here is looking at this par protector versus par accumulator. We want to show them some differences about the plan. And really see which one fits their needs better. Again, sometimes people get stuck on simply the jargon of protector versus accumulator or early cash value versus late. Let's use our comparison to show the differences between them to our client. So again, pretty evident off the beginning that the par accumulator is more money. Not by a whole lot, but enough. About $3,800 a year. And again, it'll break that down for us and tell us the exact amount later. Again, we see that they're both 20 pays, and again, these are both guaranteed 20 pays. And it's no surprise that, again, if we pay both for 20 years, that we're going to have a little bit more money deposited into the accumulator, which is that wealth plan again. Again, even on a guaranteed basis, we're sure that they're going to go 20 pays. That's fine. Now, our first chart here is going to be the total cash value. And a lot of times when I demonstrate these overlays, I show, how visually relative the charts are. Now, again, because these plans are very similar, we're actually not going to see all that many differences, kind of off the bat. I mean, the one thing I definitely notice is we can start to see that, by year 10 here, the cash is already equaling that deposit, whereas it's quite a ways off here in the protector, which is the estate plan. But again, we're going to have more kick in this later year. Now, again, like I said, sometimes those subtleties are really hard to pick up. So what I do want to show is, again, we're going to flip down here, is we're going to show our overlay metrics. So again, if I just wanted these overlays, I could show them. And again, what we do see here is we can see that in blue, the accumulator has a lot more cash early on. So business owners, this often appeals to them. Right around 20 years, and I find this is generally the case. I mean, it does vary by the age of your client, but right around 20 years is usually where I see that crossover. And again, the protector has pretty much caught up here. I mean, it's 1.19 versus 1.2. So it's really in year 23 here that they pretty much break even. Again, we can see that immediately. Now, after that, the protector actually has more cash value all the way through. So, looking at it with your client, if around, if they're thinking of taking out the cash earlier and the cash is more important as a business owner, in the early years, that may be more appealing for them. Again, same thing with the insurance benefit. Again, with the PAR accumulator, we're going to see a lot more insurance benefit up front, but a little less later on. And again, this is a very tight scenario because we've taken two exacting products. But that's an example of how you can use the overlays to help decide what's important to them. If this client had a retirement goal of taking out all that cash at age 65, we may want to go with the accumulator because it has a lot more cash value in it than that protector. Whereas, if it's all about estate preservation and insurance benefit and the cash is not as important, you know what? It's probably more of a PAR protector. And again, I know that seems fairly obvious in your case because you already know that, but sometimes it's all about showing the client and having them see that value in the later years. So that's one example of how to do it. Now, let's say, for example, our client cannot afford the full paid up additions. We want to explore maybe some different dividend options for them. So this is another place we can use a multiple whole life. What I'm going to do is, for now, I'm just going to use this little hide from report button. So if you've never seen this before, this little eyeball button here actually will hide a plan. And I'm going to hide my PAR accumulator. I'm going to leave in my full paid up additions with the PAR protector, but I am going to add another Sun Life product here. And most companies have a product called an enhanced product or an economy product. With Manulife, I believe they call it the term dividend option. Now, what generally occurs is if, let's say we want to reduce our premium here, but we still want some cash value and we want some, we want to be part of that participating account. Well, what we can do is we can choose a different dividend option. So I'm just going to flip back to Sun Life software here. This is only an option on their protector, but other companies vary. I'm still picking a 20 pay, but what I'm going to do is I'm going to change it to enhanced insurance. And again, we can modify this enhancement as well. So basically what I'm doing is I'm setting up my quote. Again, I want to keep it apples to apples, so I'm going to say $1 million. And that's good. So it gives me a base coverage amount as well as an enhanced amount. And essentially, from my understanding of these products, it's basically a yearly renewable term is the enhancement. Now, as those paid up additions from the base grow, they tend to, or the objective is to replace that YRT before it really increases in cost. Now, the result is that you get that guaranteed level insurance benefit, you do get some cash value, but it's not going to have the same kick as the paid up additions. And the other benefit, though, is that we have, it's a lower premium. So again, it's a lot more affordable. And I often compare this to, sort of a universal life if I'm looking at it quite often. So, it can be very competitive. Now again, like I said, I did my homework before and I've created some of these spreadsheets. So I'm actually going to import mine from a CSV file and we're going to dive into it. So I've done an enhanced. I did the 10-year guarantee and I just used a 20-year offset. So I'm going to open that one up here. And again, I want to name my plan. Make sure it has a really specific name. So this is the PAR protector. And I'm going to say it's the enhanced. And I'm going to say 10-year. And again, we can give it more details if we want. And I'm going to save that. So here's an option for us where we're playing with different dividends. Again, we're going to have a very different price, $40,000 versus $24,000. So again, we're cutting off quite a bit of money, but we're still going to have something that's appealing for our client. And again, we might want to show those differences of the product. So again, I'm just going to generate my report, and we're going to see some of those differences and dive right into them. Okay, so the most immediate one is, again, that cost savings here. And again, if you have a client who likes the idea of PAR, you think it's right for them, but maybe they just don't have that full ability to pay the full PUAs, again, we've got an option for them. We can use one of these enhanced plans. Again, I've done this as a 10-year guarantee as far as that enhancement option. But do get in touch with your wholesaler if you want more details on these plans from a specific company. Again, when we sum out our premiums, the big difference is going to be what we pay. And again, we're going to see it reflected in the cash value. So again, the PUA definitely has that kick. That's the guaranteed 20 pay versus this PAR enhanced. And again, insurance benefit, very similar story. Again, because there's such a discrepancy in that kind of premium deposit, there's going to be a difference in the insurance benefit. And this is really going to be reflected in our overlay. But again, it gives us a good idea of, different premium deposits versus the benefit that we get. And again, we might be able to fit the insurance need for a person into that lower paying policy and still have great inflation protection. So again, this pairs very well with a PV. But what I did want to show is kind of that return on the investment. So again, whenever you put in two different policies here, the first one being the PUA, the second one being the enhanced, that YRT built in, we're going to see a significant savings. So we're going to see actually around, by the time we finish paying these policies, because we set them both up as 20 pays, we're going to see a monetary savings of $315,595.20. So let's keep that number in mind. Again, we're always going to reference that as that's what we're saving. So what are we giving up for it? Well, again, in cash value, immediately in the first year, we're giving up $496. So that's not that bad. I mean, we still got a nice premium savings and not too different in the cash value. And again, this kind of trend continues. So if this was about cash value, at the 20th year, we saved $315,000 and, really $315,000, and the cash value that we were out by is actually 482. So it would be a nice return, but again, it's pretty close. I mean, we're getting an extra $100,000 in cash, but we had all that time savings to potentially invest this 315 as well. And that's where I think the IRR calculation is going to be really interesting on something like this, where we're comparing two different dividend options. All right. Now, again, over on the insurance column, again, we're down by about $2,400 of insurance benefit, but again, a nice kind of option since we're saving so much of the cost up front. And again, if we go out, maybe say age 85, we're down $1.4 million of insurance benefits. So we can see those paid up additions have really grown that 20 pay. And, they've grown our enhanced as well, but again, not by the same amount. So again, if you have that 315, it's really turned itself into quite a bit more insurance benefit by life expectancy. So let's boil down that IRR. And again, it looks like the enhanced doesn't have, even when we strip out those premium deposit difference, it looks like it's not as effective of a dividend as, say, a paid up addition would be. And that's just on the cash value side. Let's take a look on the insurance side here. Off the bat, again, because we're getting a lot of kick off that beginning, we actually have a very strong IRR. It looks like around age 80 that it actually becomes a little less appealing. So this is a good option for high protection in the early years. We've got a better IRR. But again, for more of an estate situation, we'd definitely be better off paying for those paid up additions. Now again, not too shabby though, considering if we didn't have the premium dollars, at life expectancy, we've got a solid IRR of around 5.7%. 5.07, and again, that's about you can see 0.33% difference in IRR. So again, still strong, still a viable option if, say for example, we don't have or I should say our client doesn't have the funds available to pay, but they still need that high protection need and they still need some inflation protection. So this kind of makes my mind go a little curious because I think, well, that eco option is pretty neat. And again, if my client's got maybe some challenges from a premium payment perspective, but what if we put in a different product? So I'm going to hide the full guaranteed PUAs here. We're going to keep looking at this enhanced, but this time let's look at it in a term rider sense. So again, I'm going to add a whole life Sun Life product. And again, I've gone ahead and done the spreadsheet, but if again, like I said, anything you can design in the illustration software can be brought into ours. So let's say, for instance, we say, forget the enhanced. Let's go back to paid up insurance. Let's do a 500 of base. And let's add a term rider on that. So I'm going to add a term rider here for 20 years. I'm going to add 500 term rider. And again, I'm having it drop off at age 70 because I don't want to pay those renewals. So again, anything you can design in the illustration software, again, is going to be reflected in that spreadsheet. And when we bring that over, that's going to make a nice basis of comparison. So again, I won't bore you too much on how to create that spreadsheet. I think we covered that already. Again, what I want to do is show you how these two products compare. So again, I'm going to import, and like I said, I've gone ahead and done all these. So I'm going to grab my one. Here's 500K of base, and again, this is Par Protector with a 500K T20 rider on it. open that up. Okay, now again, just for clarity, again, when we're doing this, our client's got to read it, we've got to read it. We want to give it a really specific name. So this is Sun Life Fire Protector. I'll grab it from there. And I'm going to say here 500, I'm going to say 500, I'll say K base, then I'll say 500K term 20 rider. Again, that's for us. I can say, you know, this is a participating whole life plan, and I can say term rider drops at year 20. Whatever makes it more descriptive for our client. So this is going to be an interesting scenario. In one case, you know, presumably our term rider should be a lot less expensive because again, we've got half the base, and again, term insurance is very cheap. On the other hand, at 20 years, it'll be interesting to see if our enhanced protection with, you know, kind of that YRT being replaced with those paid up additions can actually catch up. So let's generate the report and see which is the better option. Again, because we're comparing different funding mechanisms, I'm really going to drill down into the IRR to determine which is better for my client. And again, you know, different clients have different needs. So if cash is more paramount than insurance, that might be the decision maker. But by comparing these options, we're going to see a nice little comparison. So again, sum of premiums, we can see that here in blue, the enhanced is actually a little bit more money. So again, if premiums are maybe the main consideration, but you know, we want some whole life, the term rider might be a better option. We're going to see. I'm not actually quite sure on this one yet. Again, 500K base with a term 20 rider. It's still got great cash value based on what you're paying. Again, the insurance benefit's going to drop, and we're going to see that. The enhanced, I can already see, has a lot more cash value, but we'll look at the overlay to see the difference. And again, here's kind of our insurance benefit. The enhanced, it's got much more insurance benefit. I can see that, especially after that 20 years. So again, we'll kind of vet those different options and see. So when we look at our cash overlay here, again, our enhanced in blue actually has considerably more cash in it, pretty level all the way through. Now it's going to be interesting to see the IRR though, because we actually paid more for this policy. And again, when you do these overlays, things like guarantees are also in there. So again, if I turn on these guarantees, you know, if guarantees are of value to our client, we can also see the enhanced has more guarantees. So, you know, even though we're doing that overlay metric, feel free to use these legends as well in the interactive portion. In the insurance benefit, again, we can see that the base with the term 20 rider is actually ahead up until that 20th year. Then the term rider falls off, and the paid up additions actually struggle to catch up to the enhanced option. But you know, if the first 20 years were paramount to our client and premiums were an option, that might be a better one. Again, because in some sense we are comparing apples to oranges here, we should drill down into basically the presentation summary and see the explicit differences. So one, we know we're paying about approximately $100,000 more into this enhanced plan. Again, that would explain, again, if we're putting more money into the policy, we would expect more cash value. And again, we're going to see here, this is the 500K. It actually starts, you know, if you start with more paid up addition base rather than the enhanced, you actually in the first year get about $100,000 more cash, or $106 more cash value. Pretty insignificant, especially seeing that the rest of the way down, again, we have more cash value in that enhanced plan. Again, sometimes up to $200,000. On the insurance side, again, we're very strong on the insurance because of that term 20 rider, especially considering that cost. Again, so we have more insurance all the way up. Let's see what year. Again, I'm just clicking here. Yeah, so right about until that 21st year. And that's no surprise either, because that's when that term rider drops off. So again, if insurance benefit was the key factor for the 20 years, that might be the better one. So let's drill down into the IRRs again, take out some of those differences in the different premiums, and let's just see what's working more effectively. Okay. So it looks like 98.17 versus 98.98, and again, in favor of the term 20 rider here. Let's look out, you know, when we sort of care more about cash value. Again, term rider very strong with those paid up additions. Very strong plan. If we keep looking out here, again, the enhanced kind of picks up later on. So it starts getting better. Right, yeah. So it's better, after 10 years or so, it's got more kick to it, that enhanced one. Again, it just looks like a more efficient use of that dividend. Now insurance, again, this is where we're really curious again because we've got that rider in there. And again, you can see significantly greater internal rate of return on the insurance benefit all the way up until sort of looks like, again, after that term rider drops off. And that's when it kind of levels out. But it is fairly close. I mean, it's not too bad. If we go out to kind of life expectancy, 4.74 versus 5.07, the enhanced would have been a better option. But again, we would have had to have the ability to pay that premium. So again, kind of weigh those options when you're looking at dividends. In my experience, nothing really beats the impact of a paid-up addition as far as it goes. So that's one great example of how to use it. Okay, so let's go down into our next topic, and that's ADO, or comparing different funding mechanisms. So the other thing that comes up a lot is trying to find the right premium dollar for a client. And I'm going to flip off here. I'm going to flip off some of these options. I'm going to say, let's just take a look at this par accumulator guaranteed 20 pay. And I'm going to get rid of this enhanced option here. So if we look at our par accumulator guaranteed 20 pay, we notice that the premium is $43,650. And again, that is a little bit more than if we did, say, a pay to 100 with an offset at 20 years. So I'll just kind of flip back over to my Sun Life illustration here, pull it up. So, if I do, and again, I'm going to get rid of my term riders here and go to my coverage. And so again, I want to make it $1 million. And again, I'm going to do par accumulator in this instance because that's the spreadsheet I've set up. So again, when I look at my 20 pay, you can see my annual premium, $43,650. If I change that premium option to a life pay, again, I'm not guaranteed that it's going to offset at 20 years, but you know what? I could take that risk because I know, pretty good chance given their history that it is going to. You can see that the premium drops down to $36,000. And basically, if we're doing the math in our head, I mean, I've done this already, kind of run through it, we're talking about $3,310 difference in ADO. And again, I want to do that $6,890 of ADO would match that. So that's basically the annual difference between going from a life pay to 100 to a 20 pay. So it goes from 36 to 43. The difference is 6,890. So in our little experiment, we want to see, if we do a 20 pay at pay to 100 or with the extra ADO and match it dollar for dollar, or should we do a life pay offset at 21 years with a little bit of plus premium here. And plus premium is the additional deposit option in Sun Life. So I've actually set those all up already. And again, we've already got our guaranteed 20 pay in there. So what we need to contrast it with is another whole life. And again, we're going to use Sun Life Whole Life. This time we're going to use the pay to 100. We're going to offset it at 20 years, just like the guaranteed 20 pay. But we're going to use the ADO to match it dollar for dollar. And I think it's going to be really interesting. Presumably, I mean, if we put the same funding into them, they're both paid for 20 years, we should have the same internal rate of return. Or the same sort of cash values. So let's take a look here. So again, I'm going to import from CSV file. I'm going to click here, and again, let's just find my one here. So I'm looking for a par accumulator, life pay, but ADO to match and offset at 20 years. And let's just see here. That's good. I'm going to open it. It's going to upload. Perfect. Okay, again, I'm going to edit the title. So I'm going to say this is Sun Life Whole Life, and I'm going to change it to Sun Life Par Accumulator. I'm going to say with, it is $6,890 of plus premium. Again, this is a whole life, a 20-year planned payment schedule. Again, it's not guaranteed like the other one, but it is a participating whole life plan. And again, no term rider in this one. Okay, so I'll save that title. Again, that's going to be really descriptive. And again, it's going to be pretty interesting here. So again, we've got the par accumulator pay to 100 with 20-year plan premium. We've added the ADO to match them dollar for dollar. So let's just make sure I got this right here. Let's generate a report. We're just comparing it to the standard 20-year guarantee plan, again, which we know costs more. So again, we've done it correctly. Again, we've matched 43,650. This one in green here has the ADO, or plus premium. This one here, just your straight up 20 pay regular. So again, we put in the same deposit. The reason you can't see the other plan is it's actually hiding behind. They're identical, paid the same over time. Again, this is pretty boring. Our sum is going to be the same. We're comparing as apples to apples as you get. The only thing we've changed is one's a life pay offset at 20 years and one's a guaranteed 20 pay. So this will be interesting again when we look at our cash value. Immediately, again, we've put in the same deposit, but I can kind of see that this one actually is a little bit bigger here. We're going to see better on the overlays, but immediately I can see there's more kick here, which is strange. Next, we're looking at our total insurance benefit again. We can see a little bit bigger here as far as, and again, if I zoom out a little, you're going to see a bigger difference here. I'm going to zoom back in to make this cash overlay really clear here. So again, we've put in the same deposit, but you can see here, look at the cash value on this guaranteed 20 pay in blue here. It starts to really take off. It's actually a little higher on the one, but after that 20 years, it really takes off. Again, there's a significant difference in these later years here. If we take it out to life expectancy, I mean, we're getting $300,000 more of cash value. But we have put in the exact same deposit as well. I mean, the guaranteed plan there has a guaranteed 20 pay, whereas the other one doesn't. I mean, I don't foresee it happening, but it's not guaranteed to offset at 20 years. Now let's just look at the guarantees, speaking of those. So again, guaranteed 20 pay here in green versus the life pay with the ADO. And again, way more guarantees in our guaranteed 20 pay. And that sort of makes sense as well. But very interesting considering that we put in the exact same dollars for both these plans. When we look at the insurance benefit overlay, we can see that the plus premium one, again, ADO has initially given us more insurance benefit, but right around that, let's see here where it breaks even. So right around here at year 27 or age 77, our insurance benefit on the guaranteed 20 pay takes off. And if I were putting in the same premium deposit, I think it'd be a no-brainer which one I want as far as an estate planning solution goes. Now, this, again, it's going to be no surprise, again, no premium deposit difference, but there is a cash value difference. So the guaranteed 20 pay is down a little bit in cash for the first 20 years, and then it's up, and it's significantly up in the later years. Again, even at life expectancy, $316,000 of additional cash value, $305 of insurance benefit. Again, at the 20-year mark, it's down by $360 and down by $27. So not a significant cash. And I mean, I don't think most clients would necessarily at 70 think about the extra insurance benefit. So it's quite interesting, even funded with the same deposit. So, when we think about our IRR or our kick for, when is ADO good? When should we use it? Which dividend or which product type do we use? Kind of an interesting scenario there. And again, no surprise when we look at the IRR of cash value that we're going to have a much better IRR in this 20 pay. Everything after really, let's see here when it goes. So right around here, you're somewhere in between here. That's where it starts going up by. So right at year 22, that's when our IRR starts getting a little bit better on that 20 pay. But again, very interesting differences for an exact same deposit. Again, the fact that we're getting a stronger IRR on insurance benefit in those later years, probably the years that matter most with that guaranteed 20 pay. Again, same deposit for each one. So let's go back to the case. So this is one example of where we've matched dollar for ADO, but there's a couple different ways we could really play with that. And what I mean by that is here we're comparing something with a different product type altogether, a 20 pay guaranteed versus a pay to 100 that's been, sort of offset and matched dollar for dollar. let's say we had a different scenario altogether. So I'm just going to hide these ones from the plan, guaranteed 20 pay with the plus premium, and hide this one as well. So let's say we were trying to find out what was better for our client, and basically in the case itself. Let's say, for instance, again, and I'm going to go back here to I've just got a par accumulator. This one's a pay to 100. Again, we can't add plus premium to that 20 pay, but I have done this one to specify and say, look, let's offset it at year 21. Now you can see our premium here for this plan is $36,760. Let's suppose in this hypothetical situation that our client comes to us and says, you know what, forget about premium. I want to set aside $40,000, and obviously I want the best return. And return could be in the insurance sense if we're doing more of an estate planning, or it could be in the cash sense, maybe a business owner with assets on the balance sheet. Well, there's two different options we could really do here. So one, sure, I could say, let's add some plus premium. So I'm going to say let's schedule a plus premium in there. Again, I want to exactly match that $40,000 deposit, or whatever your number is that you're actually trying to work out, $3,240. Again, when I add that in there, and I'm going to say from years 1 to 20 because that's where I've designed my policy. Again, I've got a $40,000 deposit. Again, when I produce my spreadsheet, I can save this one down, and I'm just going to call this ADO. I've gotten a habit of saying that to my desktop there. Now, what if we said, okay, well, that's one way to hit the $40,000 mark, but what would have better bang for the buck? What if we took out the ADO and instead said solve for basically $40,000 of premium? So I've got $40,000, but I've got a little bit more insurance here of my basic coverage. So that's the other way around that. So again, we could either increase the insurance benefit, which of course will increase our cost and increase our cash values, or we could add additional deposit option. So again, I've got here a $40,000 premium. I mean, I'm off by a cent, but it should be okay. And I'm going to save this spreadsheet as increased insurance, INCIDS. And I'll save that one to the desktop too. So again, this would make a wonderful compare in LDA to find out which one is better for our clients. So again, I'm going to add the two products here, Sun Life Whole Life. And again, I'm going to import from CSV. And this one, again, the first one I'm going to pick here. Again, I save those ones to the desktop. I'm going to do the ADO. I'm going to open that one here. And in this case, again, I'm just going to say this is ADO. I'll just really give it a simple title. I'll say ADO, additional deposit option. Again, Sun Life calls it plus premium, but I think everyone gets it. So I'm going to say Whole Life, again, add the Sun Life, and the second option I'm going to do is say increased insurance. And that's my instance, and I'll upload that one. And we want to just basically find out what is going to be better for our client. Again, this, like I said, can be cross-policy. So, I mean, you might find different ways. But again, it shows you it's worth doing your due diligence because there are certain kind of permutations within these insurance plans where there are certain pockets where certain plans perform better than others, certain age groups are better than others. So I'm going to say this is increased insurance. And again, save. So again, both we know that we're putting the same deposit in. Both in this case are actually the same plan, but we're just trying to find out what has a better bang for the buck. Is it the ADO or is it increasing our insurance? And it's going to be very interesting. I don't know the result, but I'm curious to find out. And these are, again, some of the things that you can do in life design analysis when even shopping. Not necessarily showing your client all of these options, but doing your research in general. Again, same deposit for the same length, same type of plan, means same accumulation, and we're going to be off by 20 cents because that was the difference each year, 1 cent. And again, we're going to see increased insurance versus ADO. And I'm going to skip by these charts because, again, they're going to be so similar. What I want to really look at is the overlay. And again, this is quite interesting. So again, we're actually seeing that the ADO here has increased insurance. Actually, let's pick it to a reasonable year here, age 85. So it's about $100,000. And again, that's kind of neat because, again, we've put in different or the exact same funding mechanism. Let's break it down here into these deposit difference. So we paid 20 cents more. And again, actually, we have a pretty steady increase in cash value with the ADO, but it's actually a decrease in insurance benefit up until about that 25th year. So, in this case, it I would say the ADO plan actually has a stronger IRR, and it's reflected in there. So in this case, adding ADO would be better for our client than maybe increasing the insurance benefit. Again, there's some other pros for ADOs. Again, if we're, again, this is kind of a tight scenario. We haven't added that much ADO, but the other pros of ADO, if we add them, are, you have a flex in premium commitment. So, if it comes a tough year and they don't want to put in that whole deposit, well, we can always drop the ADO. We don't absolutely have to put that in like we do the minimum payment. We could also, with ADO, if we were trying to design a quicker offset, that would be good. And if we're looking to add early cash value, again, for a business owner, that would be good again. Now, some of the pros or some of the cons, on the other hand, may be that in the event of a declining dividend scale, we might have more protection on the side. So if we do this up at a reduced example, again, we might have more protection as far as if a dividend scale reduces with adding more insurance rather than the ADO. And again, that's more from the insurance perspective because we're going to have more guaranteed insurance in there. Let's just take a look if that actually pans out. And again, even on the reduced example, yeah, it looks pretty close there. ADO is slightly ahead there, so that's not a big difference. I'm talking, if we maybe maxed it out a little bit more. So interesting phenomenon there. And again, the other maybe con would be that, of course, increasing the insurance benefit would give us more commission. So anyway, that's kind of our last topic. Now, I know we kind of jumped all over there, but just wanted to show some of the different advanced options we could do, really diving down into whole life, the different funding mechanisms, when does ADO play in, when does it not, and even different variances in product type. Many of you may be sticking with that pay to 100, even doing a pay to 100 offset at 20 years. However, you may get more bang for the buck with a 20 pay, even when we consider that the ADO is if it's matched dollar for dollar. So something to think about, and again, some interesting conclusions that we can draw from comparing different products. So again, thanks everyone for joining. If you have any questions or wanted to see a concept illustrated, please get in touch, charlie@lifedesignanalysis.com. If you're new to the system, please sign up, and again, you can see some of the powerful things we're able to compare. But again, there's very easy things as well in the system. Your general term to UL to whole life comparisons can save you a bunch of time. And again, thank you for participating, and we will be recording this one and putting it up on the YouTube channel. So again, if you wanted to watch it over and over, feel free to on youtube.com/lifedesignanalysis. Again, thanks very much. Have a great afternoon.